Most people asking whether to buy a Bitcoin ETF or actual Bitcoin are asking the right question too late. There's a question that comes before it, and if you haven't answered it, the choice between an ETF and a hardware wallet doesn't matter nearly as much as you think. We'll get to that, but first, the structural comparison is real and it has real dollar consequences, so we're going to cover both. Here's what this video covers: how the fees actually work over time, including the $1,200 that disappears without a single line item, the tax difference financial advisors started flagging as a major ETF blind spot in 2026, what self-custody risk actually means in practice, and the prior question that most Bitcoin content never asks. By the end of this video, you'll have a clear framework, not a verdict, a framework, because the right answer here genuinely depends on your situation. This is educational content, not personalized financial advice. First, what each of these actually is. When you buy Bitcoin directly through an exchange like Coinbase or Kraken, you own actual Bitcoin. It exists on the blockchain. You can hold it in a wallet you control, move it, spend it, or transfer it to anyone in the world without asking permission. But when you buy a spot Bitcoin ETF like BlackRock's IBIT or Fidelity's FBTC, you own shares in a fund. That fund holds actual Bitcoin in institutional cold storage. You're getting exposure to the price, but you don't own any Bitcoin directly. You own a slice of a trust that does. As of early 2026, more than $120 billion sits in US spot Bitcoin ETFs. That's not a niche product anymore. It's institutional money that chose the ETF structure for reasons we're about to look at. The question is whether those reasons apply to you. Fees first, because this is where most people get the wrong mental model. The Bitcoin ETF charges an annual expense ratio. For IBIT or FBTC at 0.25% per year. Sounds small. Here's how it actually works. The fund doesn't send you a bill. Instead, it sells a tiny fraction of its Bitcoin holdings every single day to cover operating costs. Your number of shares stays the same, but each share represents slightly less Bitcoin over time. On a $10,000 position held for 10 years, that's roughly $1,200 quietly removed from your Bitcoin exposure, not from price movement, just from the fee structure. $1,200 full stop. Now, here's the counterintuitive part. For short-term investors, the ETF is often cheaper. Commission-free brokerages, trade, and tight bid-ask spreads beat most exchange fees. Fee drag only compounds into a significant number over many years. Direct Bitcoin has a completely different cost structure. You pay once when you buy, typically 0.5 to 1% on a standard exchange interface, or much less using advanced trading modes, and then nothing ongoing. No annual fee ever. The break-even depends on your hold period and position size. Generally, hold longer than 8 to 10 years in a taxable account, and direct Bitcoin's one-time cost beats the ETF's annual drag. Hold shorter or invest smaller amounts frequently, and the ETF math is competitive. Both are taxed as capital gains when you sell. Short term if you've held under a year, long term if over a year. That part is identical. Here's where they diverge. Direct Bitcoin is classified as property under IRS rules, specifically IRS Notice 2014-21. That means the wash sale rule currently does not apply to it. If Bitcoin drops and you sell at a loss, you can harvest that tax deduction and immediately repurchase Bitcoin. No 30-day waiting period. Bitcoin ETF shares are securities. The wash sale rule applies. Sell at a loss and rebuy within 30 days, and the IRS disallows that deduction. This gap is bigger than it sounds. In a volatile asset like Bitcoin, which has seen 40 to 70% drawdowns in prior cycles, the ability to harvest losses and immediately re-enter the position is a meaningful tax tool. Financial advisors working with high net worth individuals are now flagging this as one of the ETF's most significant structural downsides. One important caveat though, Congress has proposed extending wash sale rules to crypto. That hasn't passed as of mid-2026, but it's an active area. Check IRS.gov for current status before building a tax strategy around it. The other tax difference is reporting. ETFs send a standard 1099-B through your broker. Familiar, automatic, simple. Direct Bitcoin now requires Form 1099-DA, which exchanges began issuing in 2025. It's more manageable than it used to be, but if you're moving Bitcoin between wallets or transacting frequently, the tracking burden is meaningfully higher. Comparing the custody. This is the section where most people underestimate the risk on both sides. With the Bitcoin ETF, Coinbase custody holds the Bitcoin in institutional cold storage, multi-signature security offline vaults, unsecured against theft. You cannot lose your IBIT shares by forgetting a password. Your brokerage has account recovery. The Bitcoin stays locked regardless of what happens to your login. 9 of the 13 US spot Bitcoin ETFs use Coinbase as custodian. That's institutional grade security, but it's also a concentration risk point worth knowing about. With direct Bitcoin, you are the custodian. That's either its greatest strength or its greatest weakness, depending on how prepared you are. 4 million coins gone, not from hacks, not from price crashes, from lost passwords and discarded hard drives. A hardware wallet and a properly stored seed phrase solves this, and modern hardware wallets are simpler than they used to be. But just get a hardware wallet isn't the same as actually doing it correctly. Storing your recovery phrase somewhere physically secure, not digitally, is a real operational step that many people skip. The other self-custody failure mode, leaving Bitcoin on an exchange and calling it self-custody. It isn't. When you leave Bitcoin on an exchange, you hold a claim, not Bitcoin. FTX customers learned this the hard way in 2022. If you're going direct, go all the way. Hardware wallet. Recovery phrase stored physically in a secure location. Otherwise, the ETF's institutional custody is genuinely safer than the exchange custody dressed up as self-custody. Comparison with retirement accounts. This might be the ETF's single biggest structural advantage and the one that matters most for the average investor. You cannot hold Bitcoin directly in a standard IRA or 401k. Technically, it's possible through a self-directed IRA with a specialized custodian, but that route involves higher fees, more paperwork, and significant administrative complexity. A Bitcoin ETF can be held in any standard Roth IRA, traditional IRA, or 401k plan that includes it in the investment menu. What that unlocks for a Roth IRA specifically is that every dollar of Bitcoin gains, if they materialize, grows completely tax-free. You pay no capital gains when you sell, no tax on the upside at all. For a long-term investor who believes Bitcoin has meaningful upside over the next 10 to 30 years, holding that exposure inside a Roth IRA through an ETF may be significantly more tax efficient than holding direct Bitcoin in a taxable account, even after accounting for the 0.25% annual fee. The fee drag on a Roth IRA position is the price of admission to tax-free compounding. Depending on your timeline and position size, that can be a very reasonable trade. Now, I want to push back on both sides of this and on the entire framing in this video. The case for ETFs gets oversimplified as if it's safer, it's easier, just buy IBIT. What that glosses over is that the ETF strips out two things that make Bitcoin structurally interesting: the wash scale flexibility and the ability to take direct custody. For a large taxable account held long term, those aren't footnotes, they're real dollar consequences. The case for direct Bitcoin gets oversimplified as own your keys, it's not that hard. What that glosses over is that most people who say they own Bitcoin directly still hold it on an exchange. That's not self-custody, that's trusting a private company with no FDIC insurance. FTX customers trusted one too. But here's the deeper problem with this entire ETF versus direct debate. It's the wrong question to be starting with. The ETF versus direct question is a structural question. It assumes you've already answered the prior question. Do I have a real thesis for owning Bitcoin at all? Here's what a real thesis sounds like. I believe Bitcoin is a scarce, fixed supply monetary asset that will capture a meaningful share of global store value demand over the next 20 years, and I'm willing to hold through 60% drawdowns because I understand the underlying argument for why that should happen. Here's what a non-thesis sounds like. It went up 80% last year. My coworker mentioned it. I don't want to miss it again. Most people buying Bitcoin right now through an ETF or directly are in the second category, not because they're unsophisticated, because nobody asked them to articulate it before they bought. And without a real thesis, the wrapper doesn't matter, because at the first 40% drawdown, which is not a hypothetical, it's a historical regularity, you'll sell both the ETF and the direct Bitcoin for the same reason. You didn't actually know why you owned it. Write your thesis in one sentence in the comments. If you can't do it in one sentence, that's the answer, and that's more useful to know now than after the drawdown. The second thing nobody says clearly enough, even if you do have a thesis, Bitcoin probably shouldn't be the majority of your portfolio. This is an asset that has dropped more than 50% multiple times. It has no earnings, no cash flows, and no floor below which it cannot fall. Asymmetric upside and speculative risk are the same thing, described differently depending on whether you're bullish or not. Most serious allocators who believe in Bitcoin treat it as a satellite position, somewhere between 1% and 10% of a portfolio. portfolio sized by one specific question. If this went to zero, what would actually change in my life? On a $200,000 portfolio, a 5% Bitcoin allocation is $10,000. Painful if it goes to zero, not life-altering. A 40% allocation is $80,000. That's a down payment on a house. That's 2 years of retirement contributions. That's a number that changes decisions. Size it at what you can lose without changing a single other decision in your life, then let it run. Mistakes. There's 3 mistakes that cost real people real money here. Mistake 1, choosing the wrapper before answering the thesis question. The most expensive version of this is that someone buys IBIT in a taxable account, not a Roth IRA, because it felt like the sophisticated move. Bitcoin drops 45%, they want to harvest the loss, they can't rebuy for 30 days because of wash sale rules, they sell, wait, Bitcoin recovers 30% before they back in, and they've permanently underperformed direct ownership, not because of fees, but because they chose a structure without understanding its tax constraints first. The fix is that before you pick the wrapper, answer 2 questions. A, do I have a real thesis? And B, which account am I putting this in? The answer determines the structure, not the other way around. Mistake 2, staying in GBTC when lower cost options exist. Grayscale's original Bitcoin trust charges 1.5% annually, 6 times more than IBIT or FBTC for essentially the same exposure. On a $50,000 position over 10 years, that fee difference exceeds $18,000. If you're in GBTC with unrealized gains, switching has tax consequences, so calculate those first. If you're starting fresh, there's no logical reason to start there. Mistake 3, sizing Bitcoin like it's an index fund. Some people add Bitcoin to their portfolio the same way they'd add a sector ETF, 20%, 30% because they're bullish. That's not a sizing decision, that's a bet sized by conviction rather than by the consequence of being wrong. The question isn't how confident you are. The question is, if this went to zero, would it derail something that matters? A down payment, a retirement date, a kid's education? If yes, the position is too large regardless of your thesis. Size it at what you can afford to lose permanently. Here's the full framework and the verdict in the right order. Step 1, answer the prior question. Do you have a real thesis for owning Bitcoin? Something you could explain and defend through a 60% drawdown. If not, either the ETF nor direct Bitcoin is the right next move. Understand what you're buying first. Step 2, size it for the downside. If you do have a thesis, size the position at what you can afford to lose entirely without it affecting your financial life. For most people, that's somewhere between 1% and 10% of their portfolio, not the majority, the satellite. Step 3, then pick the structure. Roth IRA or tax advantage account, ETF. Long-term taxable account with genuine self-custody capability, direct Bitcoin. Both ETF and retirement, direct in a hardware wallet for sovereignty and tax flexibility. The ETF versus direct debate is real. Fees, taxes, custody all matter, but they're downstream of the decisions that actually determine your outcome. Do you understand what you own well enough to hold it through a 60% drop? And have you sized it so that drop doesn't derail your life? Get those 2 things right first. The most expensive mistake in this entire video isn't choosing the ETF over direct Bitcoin or direct Bitcoin over the ETF. It's buying either one without a thesis at a size you can't emotionally or financially hold through the volatility that is guaranteed to come here. The wrapper is a rounding error. The prior question is the whole game. Quick reminder, this content is for general educational purposes only. Tax rules, fee structures, and IRS guidance on crypto can change. Verify current details at irs.gov and directly with fund issuers before acting. Talk to a qualified advisor for your specific situation. All investing involves risk. If you decided the ETF route makes more sense and you don't have a Roth IRA yet, please, I would definitely recommend doing some research into that. If you're leaning towards direct Bitcoin and want to understand sizing, also let people in the comments. If this framework helped you make a clearer call, subscribe. Let's map things out one decision at a time.